Some people have different comfort levels with different property types, and each property type has different dynamics. Some can be more management intensive than others. For example, residential tends to be pretty management intensive. Even if you have a third party manager in place, which most investors will, it still can demand more of your time. So again, there has to be a comfort level with the product type. In addition to that, also, while it may seem obvious, price range is an important consideration. Right now in today's market, if you have a certain amount of cash that you're willing or ready to invest, it's not going to go as far today as it would have maybe 2 or 3 years ago. Your lenders are much more stringent on what they're willing to lend in terms of loan to value ratios, things of that nature. So again, important consideration. In addition to that, beyond that, you're going to want to refine your search and your criteria by looking at other things. For example, like the target or the indicated rate of return. Obviously, as investors, we all want to get the highest rate of return that we can, but there's always a risk-reward relationship. So if you're very conservative, it might be that you want a single tenant occupied property, a credit-rated tenant like a Bank of America with maybe a 20-year lease, but you're going to end up taking a low rate of return for that. Maybe that's appropriate for you. In addition to that, maybe you're willing to take on a property with some vacancy, with more risk. So that's an important consideration in terms of the rate of return. The age of the property and the property condition comes into play. Maybe you're willing to take on the risk of some renovation work, repositioning a property for the potential for increasing rents and getting an improvement in the tenancy. The number of tenants at a property comes into play. Generally speaking, if you have more tenants, a multi-tenant building, there's some less risk involved in that versus a single tenant building. And then also vacancy levels. Even though today, right now, we're in a soft office market, there are investors that at the appropriate price, they're willing to come in and buy office properties with high vacancies and deep discounts on pricing and repositioning those properties. So all these are factors that you're going to want to consider in terms of helping you refine your search for the right property for you. Charles, why don't we switch gears and dive into the numbers more at this point? What comes to mind to you in terms of just some basic metrics or important considerations looking at the numbers on an investment property?
Well, anyone who's ever looked at an investment property on the commercial side has heard the term cap rate or capitalization rate. And that's the first thing you hear. And that's many times the first, fence that you need to jump to get over, what's the cap rate on the property? So what are we really talking about when you hear the term cap rate? So it's obviously used in commercial real estate, and it's the expected rate of return on the property. So if you're looking in a specific market area, one of the things you're going to want to see is what are the cap rates on other like properties. So if you wanted a cap rate of 8% and everything else is at a 7%, that might not be the property for you. Now, one other thing about this, they also call it the non-leveraged rate of return because it doesn't include financing. And the reason it doesn't is that you're using it as a comparison tool. And if you're going to use it as a comparison tool, you want to take out things that are very specific to the property, like financing. So let's talk about cap rate. Now, how is it calculated? Well, we have what's called the formula. So hopefully that's easy to remember. So the I is net operating income. Net operating income is very simple. It's revenues minus direct operating expenses for the property. So it's taxes, it's insurance, common area maintenance. For an office building, it might include utilities, suite cleaning, landscaping, things of that ilk. The R is cap rate and V is value. So if you're looking at a property and you know what the net operating income is and you have an asking price, you could figure out what the value is of the property. Actually, if you have the income and then the value, you can figure out what the cap rate is. So we have some equations here at the bottom. Value equals the income divided by the rate, or the rate, which we were talking about earlier, is income divided by value. So here's an example. You're looking at a property. It has a net operating income of 150,000 and the asking price is 2 million. So you're trying to figure out, is this a fair asking price? Is it high? Is it low? Well, 150,000 divided by 2 million is 7.5%. And that's where you're going to use that 7.5% to look at what else is selling in the market and decide whether that is a number that works for you. So the benefits, and this is why the cap rate is always used first. It's a simple comparison tool. By not using any debt, your returns aren't skewed by things that are very, very personal and specific to the property. It also allows investors to benchmark the performance against those market averages. So if you see what the market average is 7% and you see something as a cap rate of 8%, well, if it's a solid investment, that's a pretty good return and it's better than market. So here are the problems with cap rate. This is why it's simply just the first step in the property. It ignores all the other costs associated with buying the property. So when you buy the property, you have transfer taxes, you have the cost of inspecting the property, you have legal costs. Those can be rather significant. Those are ignored by a cap rate analysis. The cap rate analysis is also at a moment in time. It tells you nothing about prospects in the future, which goes into the next point, which is it fails to capture what might happen in the future. And as we said earlier, it ignores debt and leverage. Now that's really good for an initial analysis, but it doesn't give you your true rate of return, which is what you're looking for, is your true rate of return. So I'm going to shoot it back over to Chad, who's going to talk about a more detailed way of looking at the returns on the property and what you need to look at.
Sure, Charles. So having mentioned the shortcomings of the cap rate leads us into a discussion on what's called the cash on cash rate of return. And really, it's a better metric, a better rate of return that tells you your true rate of return given the cash you've invested in addition to the cash returned by the property in a given year. So as Charles mentioned, for example, the cap rate doesn't really consider all your transaction costs beyond the purchase price, which there are many. So the cash on cash return takes that into consideration. In addition to that, Charles also mentioned the cap rate doesn't consider your debt structure used in financing the property. The cash on cash rate of return considers that as well. In addition to that, the cash on cash rate of return, when we project it out over several years, which we typically do, and we'll get into that in a minute, it considers the escalations in the leases, the scheduled cost of living adjustments, also likely increases in the operating expenses to some level or another. It also considers a vacancy rate, market vacancy rate, where very often the cap rate that you'll be presented with from a marketing package does not have that and does not take that into consideration. So before we get into the numbers a little bit more in a real life example, Charles, oftentimes we find that call it the casual investor, again, the non-real estate professional that's not doing this every day, there's several things that they tend to overlook in terms of doing their own financial analysis. You want to touch upon some of that?
Absolutely. Let me go to the slide. Well, first off, many times, when you're doing the analysis, you sort of ignore the transaction cost beyond the purchase price. It was one of the weaknesses of the cap rate. And if you're not putting that into your initial cost, that's a big problem. You're not getting a real number when you're talking about your cash on cash returns. It fails to do something really important. And Chad and I were talking about this, that once you buy a property, the taxes could go up a great deal. What if it was assessed at $1 million and you buy it for $2.5 million? That's the right price. But you really do have to figure in the increase in taxes. And so that's something many investors, probably the number one mistake that people make when they're buying a property, is they don't take into account the fact that property taxes could go up. Not reviewing more than 1 year's worth of expenses. Big problem. So let's look at it this way. We have inflation that sort of hit in at certain times. You have years where you have lots of snow, years you have a little bit of snow. I want to look at those expenses and see if they all make sense and see if I really understand exactly what's going on with that property. Also, people fail to look and see what might I have to spend money on in the future. The parking lot looks good, but in 5, 6, 7 years, I might have to repave it. I might have to do more line striping. I might have to replace parts of my HVAC system. So that's ignored. And if you're going to hold a property for a long-term period of time, this would be a huge expense that's unexpected. And the final one is not reading the leases through thoroughly. And Chad and I have seen this many times in our career when a new a property man or a new owner buys a property and it's a big building, 50 leases. There's a lot of things that are missed. And so you have to read through everything very, very thoroughly so that you don't get a call from your tenant saying, hey, this is what my lease says and we're not doing it. That could be a big problem. It could be very, very expensive. So now we're going to move on to a real life example. So I'm going to hand it back to Chad and let him go through the James Street apartments.
Sure. So this is an apartment building that we listed and sold a couple of years back. And this is a 15-unit apartment building based in Maryland, 3-story building. It's a mixture of 1 and 2 bedroom units, constructed in 1983. This sold at $1,320,000. And again, this is a couple of years ago. And at the time, the net operating income was, in round numbers, call it $80,200 in net operating income in the first year of the acquisition or the sale. So if you work through the math on that, in this case, it works out to a capitalization rate for the investor of 6.1%. And we took the 80,200 in round numbers divided by the price of $1,320,000. So in terms of just going back to some of the factors that Charles mentioned earlier, some of the shortcomings in the capitalization rate, we're focused here more on the cash on cash return, and we're working through this analysis just to show you, what the result of the cash on cash return is here. So in this case, as I mentioned, the purchase price at the time that we sold the property at was $1,320,000. We expected that to be a little bit lower. We thought the cap rate, given the age of the property, was going to be a little bit higher, maybe at 7% cap rate or higher. But in this case, the investor felt like the rents were undervalued, given what the local market was doing as far as comparable rents. So, but the important part on this slide here is that we're going through and we're listing and accounting for all the transaction costs beyond the purchase price. So Charles mentioned some of these earlier, but we've got things at the state, city, and county level of like transfer taxes and recordation fees. So here's $12,540. We're going to have a loan fee associated with the mortgage we place. We're going to have an appraisal fee that's probably around $3,500. There's some legal fees, title insurance. In all likelihood, there will be maybe some kind of a property inspection that the investor might want to do. And even if they don't want to do a physical property inspection by an outside third party, the lender is going to require like an environmental audit of one kind or another. There's different levels of that. There's going to be a cost associated with that. So, in this case here, looking at the numbers, in just round numbers, the added transaction costs here are about $42,000 beyond the acquisition price. So accounting for the debt structure, in terms of this analysis and our example to you, we're assuming that this investor placed 75% loan, 75% loan to value, which would be a mortgage of $990,000. So given the sale price and the loan that was placed, and they have cash invested of $371,000, $770. Call it $372,000 in round numbers. So, working through the first year's income and expenses, and also the net operating income. As Charles mentioned earlier, the important thing here is that when you're generating your projected expenses, at a minimum, you have to be looking at a 3-year look back in terms of the information that you get from the buyer. They have to give you good data in terms of their operational expenses, and you have to look at that at least 3-year history. Ideally, we like to go back to like 5 years, so it gives you a better trend how the expenses are tracking, and it just levels out different fluctuations from one year to another to give you a better true sense of the operating expenses. So we're not going to work through each of the line items here. The only thing I'd mention is that we've got the gross rental income. There's some laundry equipment rental income that comes from the laundry room that's in the building, coin-operated machines. We got the various expenses listed here, typical line item expenses. On the property management fee, which is in here, typically that's going to range maybe on the low side 4% up to on the high side 6%. But again, we get to the net operating income of $80,166. Now, as we get into a longer term Proforma, which Charles will speak to in a minute, you're going to see that we account for both a vacancy rate factor and also potential future capital improvements. And that the summary I just provided, we don't have those in there just because we're looking at only the first year. We know at this point there's no vacancy, but for a long-term perspective, those items have to be accounted for, and Charles will show that a little bit later in the presentation. So in this particular case, as we mentioned, or as we've shown, we've got net operating income of $80,166. We've got the mortgage that works out to an annual amount of $76,543. Here's where we put in the lines are slightly off here, but we've put in $2,500 for an annual capital reserve escrow amount, because inevitably we'll have to at some point replace the roof. We're going to have to resurface the parking lot, things of that nature. So we put in a number of $2,500 to account for that per year. In addition to that, so at this point we've got annual cash flow after the mortgage of $1,123. They're pretty nominal. And as you can see, the cash on cash return based upon the $371,000 we have invested, it works out to be less than 1%. So in this case, we showed earlier where we had a cap rate of 6.1%, yet when you factor all the additional acquisition costs in, we're at a cash on cash rate of return of less than 1%. Again, this investor is kind of banking on the future with higher cost of living adjustments and the rent increases beyond 2 or 3%. But so Charles, why don't you take that and kind of show where we take it from there into a longer term Proforma?
So what we're looking at over here is the expected performance of the property over 10 years. And this could be really daunting, but let's break this down just a little bit. The bottom line is what we're really looking for, that last number for this analysis, because we do a 10-year analysis, because let's just say that you have a 10-year investment horizon and you're saying, I want to sell at the end of 10 years. You want to figure out, okay, where are we going to be at in 10 years? Where will our operating expenses be? What do we expect taxes to be? Okay, taxes to go up. Well, you need to build those in there and be really, really honest about where you expect to be. But that final number at the bottom right-hand corner, 118,212, is our expectation of net operating income in 10 years. Now, over here, we're looking at adding on those expenses that create the cash on cash return. Now, if that investor is right, and obviously around the country, we were seeing much higher growth rates in some places than 4%. But if he was right, then his cash on cash returns are going to go way up. But in this instance, the first 3 years, there's nothing or there's losses. And then it takes till about year 6, 7, 8, 9, where you're getting a reasonable cash on cash return. In year 10, 10.54%, where you're thinking, okay, that is a little bit better. But you obviously need to be honest about what you're dealing with here. We certainly didn't have the buyer's expectations on the property. He might have looked at it a little bit differently than we're looking at it right now. So we talked about that bottom right-hand number, the net operating income of being $118,212. So what we did was we divided that number by 7%, which we expect might be the cap rate. If cap rates go down to where they were, a few years ago, that number might be lower and it might result in a higher price. But at 7%, the price is $1,688,000. Then once we take out the sales commissions, transaction costs, we put in at 6%, we have $1,587,000. Then we figured out what was the mortgage balance after 10 years, because it was amortized over 25 years. After 10 years, still had $755,885. That leaves us with net cash proceeds of $831,528. And if you're buying in a market where it might not be really great right now, but you think it's going to do some fabulous things, that might be the number that you're really waiting for, that you're going to be patient to get that big return at the end of 7, 8, 9, 10 years. So what this provided for us is a total average annual internal rate of return, which is basically the return percentage using cash on cash numbers, of 9.52%. And a lot of our more sophisticated investors will have a goal that we won't even look at anything that won't give us an internal rate of return of 8% or 10% or 20% or 25%. I mean, we've seen some really aggressive numbers out there. If this is, Chad and I were talking about this, I mean, right off the bat, using our assumptions, the rate of return isn't all that great, especially at the end of 10 years. I'd really want that price to go way, way up. So, Chad, I'm going to hand it over to you to sort of close this thing out and give us a feel for what we went over. So we're going to go to...
Sure. So just to wrap up on the internal rate of return, it's important to recognize there that captures the time value of money. As Charles indicated, it takes you through an entire hypothetical holding period and eventual sale of a property. So it captures the terminal value and your net sale proceeds at the end of that. It's another metric that helps you compare one property to another, different rate of return than the cap rate. But again, it's a good comparative tool. So with that, just in terms of the wrap up, the most key takeaways that we can emphasize to you today in running the numbers are: number one, you have to look at a long-term history of the operating expenses. Make sure it's no less than 3 years. So if you're under contract, make sure that the seller is willing to share that information with you. In addition to that, as Charles mentioned, very often what we see in marketing packages is that when they show the operating expenses, they're going to have the last year's property taxes or whatever the current year property taxes are. But in most cases, after the sale acquisition of that property, those property taxes are going to go up, considerably. So that has to be factored into your analysis. In addition to that, we very often see investors, when they're running the numbers, fail to really account for all the transaction costs. So it's another area to pay particular attention and put emphasis on and greater focus. In addition to that, as Charles mentioned, the cap rate is a starting point, but it's not an end-all, be-all in terms of the rate of return. Even if you paid all cash for a property and didn't use any debt, then you're still really not going to get the rate of return that the cap rate would suggest, because very often it ignores transaction costs. Other things that we did not go into in greater detail but need to be considered are, looking at comparative rental rates. You could be buying a property, the initial cash on cash rate of return could be good, but the rental rates might be above market. So as leases turn over, those rental rates might come down. So you need to look at your submarket in detail and see what comparative rental rates are. Going back to the apartment example, you would want to look at locally, what other apartments, similar property types have sold for in terms of per unit prices, things of that nature. So those are other factors we didn't delve into too much, but they are important considerations. So with that, we're going to wrap it up, and thank you again, as always, for joining us for this podcast. If we can be of help with a property search or maybe looking at giving a second set of eyes to something you're looking at, please reach out to us. Our contact information, Charles, if you want to scroll to that on the screen, last slide. Our contact information is here, and we've shared that in past podcasts. So thank you very much, and we look forward to having you join us next month for our next month's podcast. Take care.